And from interest rate cuts to raising the capital gains tax. Just last week, billionaire hedge fund manager Stanley Druckenmiller said that he would not have a problem with a higher tax rate on capital gains. But what about individual investors? How would this affect them if it were to happen? Joining us right now with his assessment, Ben Phillips is founder and chief investment officer of Eventshares. Ben, good to see you. Thanks for joining us tonight.
Thanks, Bill.
You know, among proponents, one of the arguments in favor of raising the cap gains tax is that many wage earners already pay a higher tax than capital gains tax rates. So raising the cap gains rate would just level the playing field. What do you say?
Well, you know, we've looked at past examples in 81, 97, and 2003 when you saw the tax gains rate actually cut and you saw an increase in tax revenue. So for the individual, we actually think that higher cap gains taxes means that they're going to be less willing to invest in stocks. It reduces potential future growth as entrepreneurs are less willing to invest. And so we think that just means lower stock market returns and lower income for retirees who are trying to monetize their stock portfolios.
Yeah, I was going to say, you make the point that basically for retirees who may still have significant exposure to the stock market, this actually cuts back on their ability to spend quite considerably.
That's right. It's kind of a double whammy, right? So you have first the lower equity returns, lower stock market returns, right? So you have that, but then plus you have the hit from the taxes. So if we're talking from going 20% to let's say 35%, that's almost doubling the tax burden on a sale. So you sell a $100,000 stock position instead of, you know, just paying $20,000 to Uncle Sam, you're paying $35,000 to Uncle Sam.
And we often think of just the stock market when we're talking about the capital gains rate, but this applies also to small business owners in many cases, doesn't it?
Absolutely. I think it's about a 50-50 between stock sales and other capital gains, which include business sales. So you think of an entrepreneur who, let's say that, you know, they put in 10 years of sweat equity, so no cash equity, but sweat equity. They sell their business for $1 million, and you're talking about another $150,000 that they can't reinvest in the business if we go from a 20% to a 35% tax rate. So that's substantial. We think that's a drag on growth. Small businesses are the engine for job creation. They're the engine for innovation in the U.S. economy. So if we throw a wrench in that, we think that's bad overall for U.S. growth.
You also say that it's an easy tax to avoid. Just don't sell your shares.
That's right. It is one of the easiest taxes to avoid. So there is some of that encouragement for it might encourage a buy and hold investor. So there might be some of that. But again, you know, you have to ask the government, what is the intention of hiking a tax there? What would that mean? And they want to raise revenue, but actually it's counter that. You high cap gains taxes, you see lower tax revenue typically the past 3 times it's happened.
Ben Phillips with Eventshares. Again, thanks for joining us tonight.
Thanks for having me.